Hey there, this is Arthur Hill, Chief Technical Strategist at TrendInvestorPro.com. You are tuned into Next Level Charting. Thank you very much for joining us. I appreciate it. If you're watching this video on YouTube, and you like it, of course, please give us a thumbs up and consider subscribing. So today I want to step back and I want to show you the value of a plain unannotated line chart. And I think this is something we should be looking at least a weekly basis to show an uncluttered chart without any biases. Then we're going to show SPY with some chart perspective by looking at that line chart first, drilling down to the bar chart and then to the candlestick chart. And then you might hear some talk about an inverse head and shoulders for QQQ. I'm not buying into it, and I'll tell you why. So I want to start off with SPY, and what I've got here is I've got a plain chart. And I think it's important that on a regular basis, weekly or whatever, that we look at plain unannotated charts. Because when we look at this chart, it has no indicators, it has no highs and no lows, it's closes only. It's got some perspective. It goes back about a year and a half, and it has no bias on it. It's just plain. And so if we want to see what's really there, if we want to see with some perspective, we need this type of a chart. You know, we step back, we take a look, and we see what we see. So at StockCharts, what I do is I take this one step further, and I take a chart list, and this is an ETF chart list that I've got here. We've got XLI, and I've just got a line chart, and I've got no annotations on it, and I have no plans of annotating this. And below, I have the S&P 500, and that's what I'm using to compare performance. I prefer to compare performance with highs and lows, corresponding highs and corresponding lows, than use ratio charts. And the reason I'm doing this is I want the cleanest, purest, most unbiased perspective I can have. And you need to have that once in a while so you can see maybe something that you were missing before or see a setup that is materializing. So if we look at XLI here, and I'm going to annotate it, but the annotations are not going to stick. I'm going to keep it plain. And so once a week or so, I'm going to look at these plain charts and decide what I see, make my notes, and then compare them with my annotated charts. But what I see here is, first of all, you can see that XLI got a big decline here, and so did the S&P 500. Okay, but when we look here, we can see XLI has a higher low, and meanwhile, SPY has a lower low. So XLI is showing a little bit of relative strength there by not forming a lower low. And then XLI gets a break above that March high with a big surge, and so does SPY, so they're in sync. But if you look at XLI, it goes way above these February highs, a big surge. And SPY barely got above these February highs, and then it fell back. And XLI also fell back, but look at this surge that it's gotten over the last few days. So it's got another higher low working, and it's got a surge working. And you can see that really easily when you're looking at line charts, when you don't have a lot of clutter, and you have the benchmark index chart just below it. So it looks like XLI is showing some relative strength here and getting a surge breakout. You had this big decline here, and now we've got a breakout of that. You can draw a little resistance line here or something to see that breakout. So maybe XLI is going to challenge its prior highs. So I was doing this exercise through my charts, and I was looking at just the plain line chart for SPY. And I've got a composite breadth model, and it is net bearish, but the market is really split. Like 50% of S&P 500 stocks are above the 200-day and 50% are below. So it's a very split market. But I was looking at this, and you just have this huge advance. You know, the last correction that we had was in September, October here in SPY, and then we got that big breakout. And I'll go ahead and open that chart up a little bit so you can see that last consolidation. So there's the last consolidation, and there's the breakout, and you had this huge move, and now we got this decline. I was looking at this decline on its own, and it looks like a falling wedge, and so you get the breakout, and then you get the throwback to the breakout zone here, and it's turning into support. And so I'm like, okay, well, maybe I need to rethink. And so I took this information and I put it on a bar chart. So here's SPY on the bar chart. And what we can see is there's the big breakout. And that was the last decent consolidation in September, October 2020. And we had a couple small consolidations along the way. And then we had what appeared to be a breakdown in January, and then a bounce and a lower low. But now we've got this big surge here in March that broke out of the wedge and it formed a higher high. And so this is interesting because if you look at the structure, you have a huge advance and you've got a decline that retraced around 40%, give or take a percent, but it retraced between 1/3 and 2/3. So it's like, 3 steps forward and 1.5 steps backward, if you will. So that could be a normal correction. And this breakout occurred with a big, strong move, as we'll see when we look at normalized rock. And now we got what looks like a throwback to the breakout zone. So now I'm going to go one step even further by going to a candlestick chart and a shorter time frame. So here is the candlestick chart, and we can see there are some big swings in 2022. I mean, look at this, down 10%, up 6%, down 8%, up 4%, down 5%, and then there's that big 10% move. It's like 10.7% in 11 days, huge. And then you have the pullback here. And so I'm saying, okay, well, the wedge on that bar chart looks like a potential breakout from the wedge, longer term bullish. Now my trend indicators are still bearish. That's what has me iffy. And as I said, the 50% of S&P 500 stocks are above the 200-day and 50% are below. It's a very mixed market. In fact, this is probably why you can see here's the September 2021 high. Well, we're still below that high. We've basically gone nowhere since September 2021. But if you look at this, you have a big surge, you have a 50% pullback and a falling channel or flag, and you return to the breakout zone. So this is typically a bullish setup. You have 2 big steps forward, you have 1 step backward. And then you start to firm here. You get a long black candlestick, a big gain, a big loss, and then you have this kind of 3 candlestick reversal with the long black candlestick, the spinning top, and then the long white candlestick. So we do have a short-term reversal here, and this could signal a continuation higher, and we might exceed this high here. Now, the thing is, a strong breakout should hold. If you go back to this breakout in October, you can see we had a little bit of a throwback. That's okay. And then we had a surge and we just were off to the races. So if we get a surge, maybe we get a little throwback into that 440 area. Okay, we'll take that. But if we go below this low here at 437, then that negates this setup. So that's what I would be watching for going forward. Now, as I mentioned, what has really piqued my interest in this little short-term reversal pattern here is only the fact that we had basically an outsized advance here in March. And how do I know it's an outsized advance? Well, I've got an indicator here, and it's basically the normalized rate of change. It's the 20-period point change divided by 20-period ATR, average true range. So it puts that point change in relationship to ATR values. So we can see here, I'll put on the crosshair again. So if we look here at the peak here, we see that this was a 3.83 ATR move. And you have to go over to the left side to see the value of normalized rock, 3.83. So that was 3.83 ATR values, that move. And that is an outsized move. And an outsized move is important because it's the type of move that can jumpstart an uptrend. So if we go back here to November of 2020, we can see that we had an outsized move there in October, actually, and then again there in early November, and that's when we were getting this breakout here. So it was combined with an outsized move. So that's important. And if we go back to the current situation here, we can see that this is a CCI. It's a 125-day CCI, and it goes bearish with a move below -100 We also had an outsized decline, so that turned the trend down. This indicator, it's a trend following indicator. It's still bearish. It needs to move above plus 100 to turn bullish. But we did get this outsized advance here in March, and that has piqued my interest in this decline because it's come back to a potential reversal level. So this could be the early warning of a trend reversal, and it would be confirmed with CCI moving above 100. Now, these two indicators are part of the Trend Investor Pro Indicator Edge plugin. You see the plugin link on the right. You click that, and if you scroll down, there you can see the plugin information there. And over on the left at the top, you can see at the bottom here, there are all the indicators that are available. So check that out if you're interested in these. So now I want to talk about that potential head and shoulders, inverse head and shoulders in QQQ. This is the main analysis page at trendinvestorpro.com. And there you can see you've got a market regime page, bull market or bear market, an ETF trend signal table, and then here's the recent commentary. And I'm going to go over the commentary from Thursday, April 21st, a section on that inverse head and shoulders pattern. And here's the chart that I'm showing. So basically, you're probably going to be hearing about this inverse head and shoulders. You got the left shoulder, the head, and now we've got this decline that might be forming the right shoulder. And if you get a break at 370, that confirms the pattern. That's the neckline. But I've got a couple problems with this pattern. First of all, this decline is 85 points. And if you look at the height of the head and shoulders, it's 51 points. So the height of the pattern is more than 50% of the prior decline. And a head and shoulders is supposed to be a major reversal pattern, an inverse version of it. And the fact that the pattern is more than half of the prior decline means it doesn't really look like a reversal pattern to me. It's too much of the prior decline. The second thing is, it doesn't confirm until you get a break above 370. And when you get above 370, well, you're already closer to the high than you are to the low. So that doesn't make much sense either, and it doesn't look like a tradable pattern. That's the main thing. It's not a tradable pattern, and I think we have to focus on tradable patterns, and that's what I do in the next section when I look at the candlestick chart for QQQ. So check out Trend Investor Pro if you're interested in that. So if you'd like to know more about trendinvestorpro.com, you can click on the link below in the description. Again, if you like this video, please give us a thumbs up and consider subscribing to StockCharts. Thanks again for tuning in. Have a great day, and I'll talk to you again next week.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.